Next question. A question from January 21 SFM examination. Question number 1B. Proposed foreign investment involves creation of the plant with an annual output of 10 lakh units, that is 1 million. The entire production will be exported, highlight the portion exported, at a selling price of $10 per unit. So the export consideration is $10. At current exchange rate, dollar cost of local production. The local production cost is given in dollar currency term, equal to $6 per unit. Dollar is expected to decline by 10% or 15%. The change in the local cost of the production and the probability from the expected current level will be as follows. There are 40% chances that dollar will not decline, and so the reduction in the local cost will be 0. Another 40% chances it will, that is a decline by 10%, and another 20% chances say it will decline by 15%, and in that situation the reduction in the local cost of the production dollar per unit is 0.30, and over here it is $0.15 additional reduction. The plant at the current exchange rate, highlight the portion current exchange rate, will have depreciation of $1 million annually. Income tax rate is only 30%, that is locally, which you have to pay over there. You are required to find CFAT under all the different scenarios of the exchange rate. So for these three scenarios you are required to find expected value of the CFAT assuming no repatriation of the profit. So the mean value is required to be found. Variability of the investment proposal assuming an investment of $25 million on the plant and working capital will be required at the rate of 11% on investment. On the basis of the CFAT arrived in second option, the CFAT will grow at the rate of 3% per annum for perpetuity. Like this information is given to us. Based on this, we are required to evaluate the foreign investment. Yeah, let us have understanding, let's say, how to make the calculation of answer for this question. The very first question is provided to us, very simple friends. Wherein the question says that you are required to make the computation of the CFAT. Dear students, we have been provided very clearly that we are going to export the product at the rate of $10. So we understand that, say, use your calculator, 10 lakhs into 10, 100 lakhs, or we can say that the 10 million is going to be the sales revenue that we are going to have in any of the condition. The question is providing the information that the dollar cost is going to change in a way that say reduction in the local cost of the production. In the first case, it is going to remain same, 6 only. In the second and the third, it will reduce. So selling price is 10 minus variable cost. Variable cost will be 6 in the first case, 5.7 in the second case, and 5.55 in the third case. Selling price minus variable cost will give the contribution multiplied with the number of units. What is the number of units? Number of units have been provided to us as 1 lakh. That will give us the total contribution. There is no other cost, so the contribution itself is the profit before depreciation and taxation. Dear students, the language of the question speaks that at the current exchange rate. What is current exchange rate? We do not know. The depreciation is 1 million. Now, if at all, say there is decline in the value of the dollar, then the amount of the depreciation that you can claim in the first case will be 9 lakhs. In the second case, it will be 8,50,000. With that, say we are required to make the computation of answer. So please write down answer along with me. Calculation of CF18 cash flow after taxes for each of the possible outcome. Let us see how to calculate the same. We have been provided with the three the different situations. Situation number 1, 2 and 3. As far as the sales is concerned, selling price is going to remain same 10 because that is the rate at which we are going to export it. So selling price is 10 into 1 million is the number of units. So we can say that the 10 million is the revenue. Then we have been provided with the cost. In the first scenario, there is no change. So it is going to be 6 itself. 6 into 1 million, friends. That is 6 million. Then we understand that's the depreciation. In that case, say again there is no change in the exchange rate. So the amount of the depreciation is going to be 1 million. So profit before taxes, 10 minus 7 is 3. Profit after taxes will be 70%. Because tax rate is given to us as 30%. That comes to 2.10. Add back depreciation, that is 1. In order to make the calculation of the cash flow, so the cash flow after taxes is going to be 3.10 million. This is the way cash flow will be calculated in the first situation. In the second one, what will happen? Dear students, it will be 6 minus 0.3. Why? Because the cost of producing that product will fall down by $0.30 into 1. So it will be 5.7. In that case, what is going to happen? There is decline in the dollar value, say by 10%. So instead of 1 million, you will be able to claim depreciation of 0.9 million. So 1 minus 10%. That is provided over here. That comes to 0.90. Okay. So based on that, we'll make the computation of the profit. So it is 10 minus 5.7 minus 0.9. That is 3.40 into 0.7. That is 2.38 plus 0.90, that is depreciation, and that comes to 3.28. This is the way the cash flow is calculated for the situation number 2. In the third case, same. Sales value is 10. Why? Because we are going to export the product. As far as the variable cost is concerned, in that case it is going to further reduce, say by 0.15. So it is 6 minus 0.45 into 1. So with that, say we get the contribution. So it is 6 minus 0.45, that is 5.55 into 1. Then we have been given that say this will depreciate at the rate of decline in the dollar value is 15%. So 1 minus 15%, that comes to 0.85 million. So 10 minus 5.55 minus 0.85, that comes to 3.60. into 0.7, that is 2.52. Add back depreciation, that is 0.85. So the cash flow is 3.37. This is the amount of the cash flow that we will have, say, in the three different scenarios or three different situations. So please take down answer. Now the second is very simple. Mean value is to be calculated. Probability into cash flow that we have found. So 442. So answer for the second question. Calculation of expected cash flow after taxes. So in that probability, CFAT will assign x variable to it, then probability into x. So 3.10, 3.28 and 3.37. Probability is 0.4, 0.4 and 0.2. That is the way it is supposed to be found. So 0.4 into 3.10, that is 1.24. 0.4 into 3.28, that comes to 1.312. 0.2 into 3.37, 0.674. So please make total 1.24 plus 1.312 plus 0.674. That is the way we make the total. It is 3.226. This is the cash flow in million term in dollar currency. Let us see the last question. Validity of the investment proposal means whether the project should be accepted or not. Assuming an initial investment of $25 million on plant and the working capital with the required rate of return discounting rate is 11%, and on the basis of the CFAT arrived at option 2. Highlight the portion CFAT will grow at the rate of 3% for perpetuity. So friends, over here we are required to apply a formula which is similar to the dividend discount model. So we'll make the calculation of NPV like this. It is present value of the cash inflow minus investment. So what is present value of the cash inflow? We can say it is the cash flows at the end of year 1 divided by cost of capital minus growth rate minus investment. So this is 3.226, which will grow at the rate of 3% for perpetuity. So 3.226 into 1.03 divided by cost of capital is 11% minus 0.03. So this is the cash inflow from end of year 1 onwards for perpetuity discounted in present value term. Amount of investment is $25 million. So minus 25. This is the way we are required to make the calculation of answer. So please use your calculator. 3.226 into 1.03 divided by 8%. So 41.53475. So I'm ignoring it. Minus 25. This is $million. So it is 16.53 $million. So we understand that, say, as NPV of the project is positive, so the company should accept the project. That is what we understand. So the final answer is the company should accept the project. That is what we understand. So friends, this is a very good question in terms of the language of the question, because the question is providing the information like this: a proposed foreign investment. So your company is of which country is not provided. So there is a foreign investment, involves creation of a plant with output of 1 million units. That's fine. Entire production will be exported. So from there also you are going to export it. So let us assume that, say, you are an Indian company and you are going to, say, take up a project in Australia, and from that you are going to sell the product in United States of America. At what price? At the rate of $10. At current exchange rate, the dollar cost of the local production is 6 US dollar per unit. Means whatever the exchange rate between Australian dollar and United States dollar, and taking into account the cost at which the product can be produced in Australia, the cost in dollar currency term is 6. The dollar is expected to decline by 10% or 15%. The change in the local cost of the production and the probability, so from the expected current level, is as under. So they have provided that the reduction in the local cost of the production is provided to us. So we will be able to have the lower cost of the production. It may reduce by $0.3, it may reduce by $0.45. Further, we have been given decline in the US dollar. Now this information is connected with the depreciation. The plant at the current exchange rate will have a depreciation of $1 million annually. But if at all the exchange rate declines, then in that case you will be able to claim less depreciation. Income tax rate, that's okay. And with that, so we are required to make the calculation of answer. This is what, say, very simple, because in security analysis and security valuation we cover number of such examples. This is the way we are supposed to take the decision. So we have made the calculation of, like, first of all the cash flows, then expected cash flow, and then NPV is calculated, and based on that decision.